Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. Today I'm just going to go ahead and talk about the markets. I'm outside of a public area, so it is going to be a little loud and rowdy in the background. First of all, the Dow Jones Industrial Average has closed right below the 50-day moving average. We've closed below all major moving averages. That includes the 20, the 50, and the 200-day moving average. The markets are most likely going to head lower. We don't have any major support areas for now, except for perhaps the 10,600 area. We touched that back in October. I honestly believe we'll go back down there again. Main reason being is that Germany has failed to raise enough money on a bond auction. I believe it was around $7 to $8 billion is what they were looking for. They were only able to raise around $5 billion. To governments, $8 billion is really nothing. Okay, if you can't borrow $8 billion at a bond auction, there's something wrong. And basically, because of that, the eurozone, there's a lot of doubts in the eurozone. This is basically what I've been talking about for the last couple weeks. A lot of people getting out of the euro. They're buying up a lot of Japanese bonds these days, and the U.S. bonds as well. Stocks and gold are weak, just as expected. Right now, I don't believe stocks are going to recover anytime soon. I've been telling you this for a couple weeks now. So again, there's nothing too surprising, but it is kind of underwhelming to see Germany fail at raising money, specifically $8 billion. That is a huge failure, no matter which way you look at it. Okay, now let's look at the monthly chart and see what's going on a monthly basis. First of all, this is a couple years, and basically a lot of people like to call this a dead cat bounce. It's not really a dead cat bounce, but other analysts or technical analysts like to call this an A pattern. And basically we went up to 14,000, we tried getting close to it, it didn't work out, and we basically failed, and we're heading back to the downside. It wouldn't be too surprising to see markets pull back, and again, this is just typical market behavior, and Germany basically failed to raise enough money, and when Germany fails to raise money, there's something seriously wrong, because Germany is kind of the strongest state in the EU, and it's like getting shot in the head, and Germany basically got shot, not necessarily, like with a gun or anything, but technically speaking, the banks abandoned Germany. So let's move on to the next chart, which is the volatility index. I'm gonna go ahead and look at a 5-day chart. Volatility index got a really nice bounce, but again, it didn't go back up to that $49 area on Monday. So again, there's not too much demand for volatility index right now. I was anticipating a much bigger move on the volatility index, but that's not exactly what we got. All right, the Direxion daily financial pool, that got hammered, and the main reason why it got hammered is because a lot of people are selling out of their German bonds right now. A lot of banks who own German bonds are losing money on the coupon rates. Basically, people are losing money left and right in the European bond market, especially in Germany, France, Italy, Greece, Spain, Portugal, and Ireland. So nothing too surprising here. Banks are going to continue to lose money. A lot of European banks should be sold because, again, they're losing a lot of money on the bond market. And the vast majority of people who buy bonds are the banks. And when banks lose money, whenever they buy bonds, after they take their deposits from their customers and turn around and buy bonds, and they keep selling out of bonds, it means somebody's losing money, and obviously the banks are losing the vast majority of the money here. Okay, moving on to the next chart. Oh, and by the way, quick disclosure, I'm short the FAS, so I pocketed a nice little return today. The gold market, it's having a hard time getting a bid. A lot of what's going on right now is that people don't really consider gold a good area to be investing into. Main reason being is that there's a lot of safe havens still left. People still buying treasury bonds. U.S. treasury bonds are still being bought. Japanese treasury bonds are still being bought. Gold, on the other hand, problem with gold is that when you have a money decelerating effect where you get into a deflationary state, what typically happens is that the free-floating currency of all nominal currency throughout the world shrinks. When you get a shrinkage of total nominal currency, especially euros, there's less euros to go around to buy gold, and therefore gold is deflating right now. Not too surprised there. Doesn't mean that gold is not more valuable to other assets like crude oil, and obviously gold is retaining value better than crude oil. The only problem right now is that since we have such little currency, or the amount of currency we're having is shrinking, the value of gold should shrink in proportion to the amount of money we're losing right now, and that's basically what's happening in gold. A lot of banks are bailing out of gold right now. Okay. US dollar index. Again, the chart's not really loading too well, so we'll just skip the dollar index. You guys basically know what's going to happen. The dollar's getting a nice little rally. Whenever the dollar gets a nice little rally, the stock market likes to fall, and so does gold. Okay. Euro Japanese yen. Again, this is kind of what I was talking about right here. Bear flag pattern. It went up a little bit nicely, and then it just sunk. I've seen this pattern plenty of times before. It's not too surprising that the Euro Japanese yen just sold off. Main reason being, Germany failed to make enough money, or basically raise enough money through their bond auction. Therefore, people are, taking a nice little flight into safer assets. The main place that if I was a European bank, the main place I would convert my euros into would be the Japanese yen, and I would be buying Japanese bonds right now. Mainly because the Japanese bond market is the second largest bond market in the world at around $15 trillion, right after the U.S., and because the Japanese yen is appreciating to the euro. So again, it's a double win because European banks are earning appreciation on the bonds, the Japanese bonds, and they're earning appreciation on the Japanese yen as well, the euro-Japanese yen pair. So again, that does it for me for today, guys. If you guys have any questions, leave a comment right below, and I got to go back to work. So see you guys later, and I'll have more for you in the weeks and months ahead. Good luck on your trading, by the way.